so far? I don't hear you. That's good. Today I, CA Khushbu Vagnani, an executive committee member of Bcicai, is going to take you through the afternoon session of this conference. As announced earlier, let's find out who amongst us is the lucky winner. I would like to request CA George Isaac, Chairman ICAI Doha, to please come on stage. CA George Isaac? Okay. Could I have Mr. Vivek Oberoi from Mashriq Bank to please come on stage to draw the raffle? Okay. So the winner is Rahul Ghoshal. Rahul Ghoshal from Solidarity Group. Do we have him here? Okay, he's not entitled. Next one, please. CA Pradeep Kumar Agarwal. CA Pradeep Kumar Agarwal. There you go. Yeah, come on, we've just eaten. A little bit of exercise is okay. Still. Congratulations, sir. Thank you. Okay, before we go on to the next speaker, we have a short info video about Tanjore Real Estate, who are the distributors of Larsen & Toubro realty, residential and commercial projects. Mahesh, could we have it? For more information on their projects, please visit their stand. We have it outside. Also, Nimai Consultants from Dubai, they have personalized visiting card holders for all of us with our name written on it. Please collect these visiting card holders with your name written on it from the Nimai stand. So moving on to our first speaker this afternoon. Our first speaker this afternoon is passionate about banking and finance like most of us, and in fact became a CA even before I was born. This veteran CA has been with Emirates NBD Group since September 2010 as their group CFO and has long-standing experience in Far East and Southeast Asia. His list of accolades go a long way, and these few minutes are not enough for me to summarize them. But what's interesting that I found about him, other than banking and finance, was his interest in traveling. He has visited more than 50 countries till date, and his favorite among these countries is none other than Switzerland. So ladies and gentlemen, let's welcome CA Surya with a big round of applause to share his thoughts on taming tomorrow's turbulences.
Khushbu. Good afternoon, fellow CAs, distinguished guests, and Khushbu, I will not ask when you were born. But perhaps we can have a show of hands. How many people in the room have a membership number less than 20,000? Not 200,000, 20,000. 1, 2, 3, 4. So I'm among 5 people in this room. So everybody is as young as you, Khushbu, don't worry. So I came in this morning from Dubai feeling very confident. How difficult is it to speak on a subject that's very poetic, taming tomorrow's turbulence? And then when I heard Bala speak so eloquently and Sanjay thereafter, I realized they've covered everything I had to say, and I was feeling quite turbulent during lunch because I have to say something new now to keep all of you awake. And then I reflected. I started my career almost this month, 30 years back in 1984, and I noticed that we've had many turbulent times, and I'm talking post-qualification. I remember I got my appointment letter in October 1984. I ran to my mom. She was in Chennai those days, and I said, "Mom, I've got a job." Before I started, that was the week Indira Gandhi was assassinated, those of you would remember. So that was turbulence even before I started, because I was stuck somewhere, I had to go join somewhere, and the whole country was in chaos. A few years after that, I migrated to Singapore, and for those of you who have been long established in this part of the world, there was another crisis happening here. That was the 1991 Gulf War. And Bala had mentioned in every crisis there is an opportunity. What was a crisis in this part of the world turned out to be an opportunity in Asia, because that's when the Asian tigers, another letter T, were just booming in the early 90s. And we thought it was very good. And then we had the 1997 Asian financial crisis, another turbulent year. Just about when we came out of it was 2003, the SARS crisis. Of course, by now with Ebola, bird flu, and other things, people have forgotten SARS, and not to mention the global financial crisis of recent years. So it almost seems as if we are going, sorry, let me get rid of my picture. How does this? Can somebody just bring the first slide, please? So we have been living in turbulent times always, I would say. So I'm going to start off by talking about the economy. You've heard some parts of it from Bala. I'll try not to repeat those. And Sanjay mentioned if nobody can predict the future. For my economist friends, if there are any in the room, I'll say they always predict the future right. They never get the timing right. That's the problem. Whatever they say happens, except it never happens when you want it to happen. So today we are looking at a global economy that is fraught with a lot of danger. Oil prices are not the only things that worry us. Let me have a quick show of hands. How many people here in this room have a mortgage anywhere in the world? Okay. So quite a few people, more than the 5 who have CA numbers below 20,000. And we have been going through a pace of low interest rates. And what I'm going to talk to you is going to give you some nightmares of turbulent times ahead, so put on your seat belts. I was in Washington for the annual IMF meeting a few weeks back, and the world was divided into 4 parts. You had the people in the US who thought they were getting better, and data progressively shows they are getting better. You had the people in the Far East who were doing quite well, notwithstanding what you will hear about the China story. I've lived in that part of the world for 25 years. I think they will engineer a good landing for themselves. And by the way, what we are talking about China, these days when people tell you China is slowing down, they'll slow down to a 7% growth rate. There was a time when people thought 4% was very good even for the Western world. So it's really everything is relative. And then I met a lot of people from the Middle East who felt very good, except they didn't know why they felt good. And that was before the oil shock. And then you had Europe, which clearly has problems and challenges. I won't go through, obviously, all the details in the slides, but I believe the Institute would have loaded it on the intranet, so you can see some of the data and the charts there. But what this is showing is that economic growth is going to be a challenge. The US is picking up. They are talking about raising interest rates eventually. And the Eurozone, Eurozone, by the way, is an interesting concept, and we need to pay attention to that for 1 minute, because in the GCC they've spoken about it time and again. The Eurozone created some kind of a monetary union. They did not create a fiscal union. So anytime the GCC union is about to be set up and all of you have inputs, make sure that the union, if at all, is both monetary and fiscal. Otherwise, you'll have the same challenges that the Eurozone has, where there's production in one place, but the tax transfers don't happen to some other place and the economy starts crumbling. Oops, sorry. I think, can I take your assistance to move the slides forward, please? This is called the fat finger syndrome. Shows, again, we are of a generation where we don't know how to use those little texts and types. Japan, we've seen what's happened to Japan recently, and I think it was mentioned all the nations are missing their inflation targets. But the Japanese have made an art of living with their economy, however they call it, for the last 20, 30 years. And sometimes you think it may not be such a bad thing after all. They are relatively happy. China, I talked about. And for those of you who have never visited China, I would encourage you to visit. There's a lot of trade happening between China, the GCC, onto Africa. These were things that never happened before. Again, there's an element of turbulence that will come along with it. Nobody paid attention to Africa for many years, and all of a sudden you have Chinese economic interests going there. Longer term, you need to see what geopolitical tensions it creates, and for those of us who are sitting pretty much bang in that flight path, what does it mean to us? UK seems to be doing more or less okay. They got over the Scottish vote. Again, interesting, at the time of the Scottish vote, there was a lot of debate on North Sea oil. I don't think the Scots would worry about North Sea oil if the referendum were to be held today. And we just see how much the world has changed in just a span of 2 or 3 months. And then in MENA, as we clearly say, things are positive, but there will be multiple tracks running, broadly 2 tracks, and I will touch upon that in a minute. In the next slide, we continue with the economy. We've already heard about talk of the QE coming to an end. And here's where I talked about interest rates. The forecast is for interest rates to keep going up in 2015 on to 2016. May not be as high as the peak we saw pre-crisis, but just imagine if you are borrowing at a certain level, maybe 2-3%, and rates were going to go up by another 2% over the next 2 years. What happens to your servicing costs? Depending on where you start from, I have a mortgage in Singapore where interest rates are very low. I pay 1%. So if my interest rate were to, all of you can come to Singapore. If my interest rate goes to 3%, that's a 200% increase in the interest rate, and do I have the capacity to service that? The same is true of businesses for all those of you who are borrowing or have plans to borrow medium to long term in the future. Just understand where you stand. As Sanjay said, it goes back to cash flow management. Project your cash flows, see whether you want to hedge some of your bets today. Having said that, there's nothing called the perfect hedge. It is still a view, and you could go wrong just like our economist friends. Bond yields will rise, which means the capital values of the bonds will come down. So a lot of, there will be turbulence in financial markets whenever that happens, because bonds are used also commonly as hedging instruments. I would also say when I started my career in 1984, I thought being an accountant was a cushy life. I thought joining banking would be a cushy life. If I knew it was going to be so turbulent, I might have become an economist. Next slide, please. So all countries are going to start to raise rates. We have seen the US dollar strength. For all those of you who are earning in GCC-pegged currencies or having receivables in GCC-pegged currencies and feel good about it when you send remittances back home, just think about the future. A couple of years back, people would have said that a depegging, if at all it happens, would be beneficial to GCC currencies. But if oil goes to 60 and 40 and there is depegging, imagine what happens to your remittances. So that's something for each of us to reflect on. And I'll share with you my views of what I think will happen to oil. Next slide, please. So this is about how it will affect GCC and MENA. My view is the GCC will not be immediately affected. Because of the surpluses of the recent years, the region is a net creditor. They will manage. We heard about the immense liquidity in the system, so there's a bit of cushion to tide over the next few years. That also means you have time to adjust your business strategies, your reaction to what's going on out there, to see how you want to face the future in terms of your business and trade flows. A quick show of hands again, how many people in this room are auditors, internal auditors, external auditors, consultants? Thank you. So about a third of the room. You guys don't need to worry about turbulence because you'll get plenty of consulting opportunities to address many of these issues that I'm talking about. So it's just opportunity for you. Domestic interest rates could rise in the GCC, but as I said, there is excess liquidity, so we may not rise in tandem with US interest rates, so there would be some spreads opening up initially and then they could tighten. What is of greater concern would be all these public sector infrastructure projects that have been happening in the region that have been funded with excess receipts over and above what is the budgeted cost of oil for recent years. That would slow down. That would mean business contractions. That could mean challenges in the payment supply chain. We've seen that during the financial crisis. Whether or not we want to see it again really depends on how well the governments adjust to this. I think if it lasts for the next 1 or 2 years, there's no great challenge. But if oil prices continue to stay below what they call budget break-even, and yesterday there was a report on Bloomberg, so I'd refer you to that to see where the budget break-even is for each of the GCC nations, it could spell some challenges. And I talked about the US dollar strength again. It's a double-edged sword. As long as the peg remains, it's good for this region. You should always keep your mind open to depegging, whether or not it happens, just so that you know how you're dealing with the unimaginable. Next slide, please. So we talked about oil. My sense is it will be short term. OPEC yesterday decided not to cut production. They're trying to squeeze out the marginal players. In the past, marginal players were themselves, or Saudi would be the swing factor in the production, or Venezuela if they manage to cooperate. Now, the swing factor and the marginal production will be the US shale producers. Those US shale producers who are at 70 or 80 will be squeezed out, and it seems to be almost a deliberate OPEC strategy. So I would say there's a bit of a small war out there. Thankfully, this is not a war where we kill each other. This is a war where somebody is going to drive somebody else out of the market altogether. So watch that space keenly. That would clearly have implications. If the OPEC nations win that war, oil will bounce back closer to 100. If they lose that war, it could go to the 65, the 45, and all those numbers we do not want to think about. But I'll tell you, if you take a longer term cycle, the average price of oil over the last 50 years is still closer to the mid-40s rather than the hundreds that we see these days. So these things sometimes you have to also see on a longer term basis. And don't forget what's playing out in Russia and Ukraine, and depending on whether we have a cold winter in Europe or not could also impact oil almost immediately. There are some comments there as to what it would do to Saudi Arabia, Kuwait, and the next slide, please, shows you what's going to happen in Bahrain, which is not a good story, because I think for Bahrain, they are already running a deficit and they would continue to face challenges if oil drops. So there's a kind of a double effect out there. You have all the economies uncertain, and the oil price, which is something that is keeping this region stable, and we heard about all the political stability issues, could be in for a test. So enough of the doomsday conversation. Perhaps I should move forward to something. This is even more depressing. Absolutely. And again, when I finished my CA, the good thing was there were no accounting standards. And then over the years, I realized that whatever we learnt is meaningless because new standards keep coming every year. So I'll touch upon a few standards here. The intention, obviously, in this room is not to get into the technical debate, but what some of the challenges are that we would face. So with IFRS 9, although it impacts banks and financial institutions the most, there are parts of it that would impact non-banks as well, especially rules on hedging, potentially rules on impairment, although they have a carve-out for short-term receivables. And they spent a long time going round and round, and eventually for classification and measurement, I would say there's not much change. There is an equivalent to the held to maturity available for sale and fair value categories, although there are some options that restrict you now in terms of if you choose the fair value through other comprehensive income option, you will not be able to recycle. In the past, people used to tuck it to one side, recycle it in the future. So each of you before 2017 mandatory application needs to look at some of your investments to see whether you want to make those choices or not. For those of you who have not paid attention to the systems and processes in your organization, I would suggest now's the time to start doing it, because it will lead to a change in systems and processes to some extent, depending on what instruments you deal in, whether you're a bank or you're a non-bank. But broadly, the section on classification and measurement makes life easier. The difficult portions come in impairment and in hedging. For impairment, all those of us who are in banking were praying for a long time that the IFRS definition of expected losses and the regulatory definition of expected losses coming through Basel III should align so that, we are all lazy people. We just like to do it once. But as I said, for all the consultants out here, the good answer is no, we have to do it twice, because the definitions, although outwardly seem the same, when you peel the onion, what is a 12-month expected loss is different between the Basel regime and the accounting regime. How you then bring it together, how do you then take a reported capital and apply it in your regulatory returns and frameworks? There's a lot of dirty work to be done there. And given that these issues have long gestation period, Basel III won't come in till 2019, IFRS 9 till 2017. Our life is going to continue to remain turbulent through all those years, and people are already talking about Basel 3.5, Basel 4, and so on. Also, there's a lot of hard work to be done. I know Sanjay said don't look at history, but unfortunately for impairment, you have to look at history. You need to look at history to determine probability of default, loss given default, and all those mathematicians will have a field day out here trying to help you calculate those, and how do you fit it into your respective in-house models. And these are not easy, I will tell you that. And then finally, for all of us, whether we are preparers, whether we are auditors, whether we are regulators, the disclosure requirements are going to be drastically different. And many of us do not pay attention to the level of detail that is required in these disclosures. And you need to set up, again, your systems, your internal data flows well in advance to be able to provide those disclosures. I can assure you, if you wake up in 2016 sometime, you think you have your accounting debits and credits sorted out, but you'll probably miss a step on your disclosures if you haven't taken that through your internal processes, discussions within the organization. The next slide then talks a little bit about hedging. This is a bit of a good news, especially for the corporates, because now you can use more instruments for hedging. You can hedge pools, net positions in pools if you want to, and it also, the standard also aligns the accounting requirements with what you would be doing truly in your day-to-day life to achieve economic hedging. Whereas earlier we had accounting hedging, now it brings economic hedging and accounting hedging a lot closer together. The part that is difficult, which is macro hedging, doesn't really affect non-banks very much. It is a very complex area for banks as to how we would hedge non-interest rate sensitive, non-maturity balances, which in simple terms, cutting out the jargon, is current and savings accounts. And that's still a standard in the making, but the first part, I think some of you can take advantage of it. For those of you who want to take piecemeal advantage, you've missed that bus, because now the entire IFRS 9 has been issued, the classification, measurement, impairment, and hedging. So you need to take the whole thing in one go. You did have an option in the past to take one section, not move to the other section. The next slide talks about another important standard that will affect all of us. This too has deep implications on systems and processes, revenue recognition. While it hasn't dramatically modified what was there in IAS 18 and IAS 11, you get into now a contract-based recognition of revenue. And we have to ask ourselves, how many of us have systems that would recognize all those contract events, and how do we recognize it in our financial statements? I met a few people earlier from Betelco, and my heart goes out to anybody who's in a telecom company, a construction company, because all of you are going to have a tough time with IFRS 9. However, the good news is that this is one standard that cuts across all industries, it cuts across all entities, and in fact, there's a greater challenge for those of you who follow US GAAP, FASB, because they are going to align themselves with IFRS 9. So I think for the IFRS people themselves, for a few industries, it's going to be tough. For those who follow US GAAP, the whole thing is going to be a brand new ball game. Although it doesn't affect banks very much because the bulk of our earnings will be under IAS 39, IFRS 9, those of us who are in the credit department evaluating customer financials will now have to understand the new accounting rules to see how we can assess client financial statements, get a right understanding of their cash flows, of their P&L, and so on. Once again, although I've not mentioned it in the slide, there are detailed disclosure requirements on movements, etc., which is where I think all the hard work lies as well. A few other standards I'll touch upon. I'm not going to go through all the standards, but the next slide shows a few things that are happening. IFRS 10 on consolidation of standards. The standard has moved away in terms of the definition of the notion of control, and it's no longer just the percentage of shareholding. You could be in control of a company for accounting standards purposes with less than 50% shareholding. A lot of it really depends on your ability to vary the operating revenues of the target company. And again, there are a lot of tests that you need to watch out. It's a potential minefield where people did not consolidate before, you might end up consolidating, and vice versa. And it's also not the actual control you exercise, but it is the power to control, the ability. So even though you may not have appointed all the directors, even though you may not have called all the options you have, if you do have the power, the right, then you have to assess control. And lastly, and this is something interesting that just came up in the last few months, those of you who have subsidiaries, associates, joint ventures that are listed in a stock exchange and therefore has a level 1 price to it, you may be forced to value those at the level 1 price rather than under the current basis of equity accounting that you adopt. I don't have a slide on leases, but for those of you who are in that industry, don't worry, the standard has been discussed for the last 10 years. It will continue to be discussed for the next 10 years. Okay. Now we're done with the doomsday conversation, I think. We'll go to Basel III capital and liquidity. Show of hands, how many bankers in the room? Or how many people audit banks? Okay, so still we have about a third to a little bit more. So this is strictly for us. For the rest, I would say the only thing you need to know is if you are investing in banks, don't expect the same return you got pre-crisis, that you will be able to replicate that post-crisis. That in summary is all the next 5 or 6 slides are going to tell you about. This one diagram shows it all, and the one message you take away is life is going to get tougher for bankers. I've broken it up into a few slides so that you can see it in bigger font. So first we'll talk about capital requirements, which is the next slide. And the central banks, the Financial Stability Board, post-crisis have come up with rules as to how they would look at banks' capital. And they're setting minimum requirements for common equity. There were banks in the world that had less than 4% of common equity. They had all these hybrid instruments, which we realized during the crisis don't really provide the necessary backstop to protect the depositors or the economy. And there's a multi-layered approach as to how much you need at each level. And against your risk-weighted assets, you need a minimum of 8%. The story does not stop there, because we have the next slide that then shows you other requirements. These are some qualitative, some quantitative. The top right-hand corner shows what we call, you would hear the term SIFI. These are systemically important financial institutions. The regulator can impose additional capital requirements on the SIFIs. People talk in the range of 2.5%. So what's an 8% could become a minimum 10.5%. And then there's this whole debate about buffers and pro-cyclical and counter-cyclical movements between your earnings that flow through and how it affects your capital. And then a few regulators on the bottom left decided to throw the whole concept of models away because banks were using internal risk models to determine what their risk-weighted capitals were. And the regulators say, just give me a simple leverage ratio. You need to be able to match that 3% leverage ratio, otherwise I would believe you're a risky financial institution. All this put together means a higher level of capital, and all this means a lower level of earnings. For those of us who are within the industry who audit, the details go into thousands of pages, and the turbulence is really trying to understand it before the regulator changes the rules, and that's been happening quite often. The next slide pretty much touches upon some of these things that I said, and there is going to be a challenge to raise capital increasingly. And there are debates whether you should raise capital at the operating company level, the holding company level. There are different risk parameters, and just recently, because bail-in to protect the depositors is easier at a holding company level, in the past, people used to give a premium for that, now they go at a discount. So again, instruments that you thought were good for you in the past may not be good for you in the future as an investor. The next slide then talks about other regulatory changes, and this is the part where the fun begins for us finance people. Immense reporting requirements. My own bank's Pillar 3 disclosures run into some 30 pages. Banks like HSBC have much more. They are obviously global banks. Auditors have to audit it, and there's a lot of data governance that goes behind it, which means significant investment in systems. It's almost impossible to monitor the myriad complex interactions between regulations, real life. And then I'll touch upon the last point, moving away from capital. It is not just about capital, it is about liquidity. And although we heard from the earlier speakers there's plenty of liquidity, the challenge with liquidity is it short-term, is it long-term? And if we go back to our old days of the textbook, it was just about sources and uses of funds and the maturity profile of funds, which takes us to the next slide. And sorry, the next slide, please. Okay. That's okay. You can reboot, but shall I keep talking? So liquidity for banks, we are looking at the net stable fund ratio, which is more of a longer term ratio for banks to be able to manage protracted drawing on their own balance sheet. That's the net stable fund ratio. And then there's a liquidity coverage ratio, which is more of a short term ratio. That acronym there is high quality liquid assets. So these are cash and near cash elements. And how does it compare with the maximum net cumulative outflows you have over the next 30 days? And you have to try and balance both. It's easy to manage one, but as you manage one, you create a problem for the other and vice versa. So that's the job we have to manage on a day-to-day basis. Speaking more of liquidity, the next slide then shows you in a more schematic way all the things we need to do and how they interact at an operational level, at a tactical level, at a strategic level. What are the objectives we have? What are the tools we have? And the challenge, as I said, is not just one thing. If you need it to blend together and work in sync, you have to watch out. We also talked earlier about interest rates, and I can tell you one truth about banking. You can manage interest rate risk, you will create a liquidity risk. If you manage liquidity risk, you will create an interest rate risk. You can never manage both at the same time. So whether times are good or bad, at least as a banker, I live in turbulent times always. I think with that, I come to the end of my session, ready to take questions from the audience. Thank you.
I request the volunteers to collect the questions, please.
I'll do. So this question says, will there be any option of GCC countries to accept depegging if oil prices go down, say below 60? What is the factor that may lead to depegging? So I think the whole story of depegging, we could be talking here forever. It's a scenario that I asked you to plan for. There are many pegged currencies in the world, even outside the GCC. You have the Hong Kong dollar that's pegged. You have many other countries that have close pegs. My belief is you don't have to worry about pegging risk until oil itself is priced in a different currency. So when people start pricing oil in euros, then start worrying about a depegged risk. As long as oil is priced in dollars, that risk is quite minimal, I would say. Do you expect the US dollar to move within a narrow band, or will it be volatile? If I knew this answer, I'd be trading the dollar outside. But it's fair to say that as interest rate differentials open up, the dollar will be stronger relative to other currencies. That's what hurt the dollar leading into these last few years, where they were at zero interest rates. As they raise interest rates, they will be relatively stronger. That's the conventional view. But then convention has been proved wrong time to time. Please.
How do you manage liquidity mismatch? We have seen a couple of investment banks failing here in the Gulf to this mismatch. Your views, please.
Okay. So if you look at history, I would say more banks